This is the volume profiling basics portion of the core analysis module, and this is the second portion that comes in on the tail of the introduction to volume profiling presentation that we gave earlier. So in this section, what I wanted to do was basically give life to the concepts that we discussed in the introduction to volume profiling, give those words life through charts now, and so that the concepts continue to sink in as we move forward. So in our first chart example here, volume profiling basics, the normal distribution. As you recall from the introduction to volume profiling, the normal distribution is what ties volume profiling to our core philosophy, our core trading philosophy of auction market theory. And as you recall, the normal distribution basically organizes data along a bell-shaped curve, which provides important statistical data points for us, especially in trading, because it provides the mean, the population density, and all the outliers there of a given data set, and that really helps us identify value, the value area, and unfair pricing. That is what basically ties volume profiling to auction market theory, and that's why at its core, if we use auction market theory as our core philosophy for trading the market, volume profiling is all you really need to know with regards to analysis to help you be successful. Volume profiling, we're starting fresh with volume profiling as our core foundational analytical tool, and then from there we're going to layer on additional types of analysis, but all using the core foundational analysis, which is this volume profiling. So when we're looking at this curve here, what you'll notice is we have our typical curve right here. And what we've done here is we've basically turned the normal distribution curve on its side. And now this mirrors what you actually see here in the actual profile on the chart. So this is the volume profile. All of these horizontal lines represent how much volume traded at that specific price point. Every single price point has a certain number of contracts or shares that traded at each price, and they are evenly distributed here according to the normal distribution and according to their value area, the mean, and the outliers. So that's what we're looking at here. And if you remember, volume profiling is all about helping us identify those price levels where you're seeing acceptance or rejection. So if we continue to look at this, right here in the thickest part of the profile, that is acceptance. So this entire area right here is acceptance, right there. That is entirely acceptance. Everything beyond that zone is price rejection. Right here. That's rejection. That's rejection. So as you recall, auction market theory asks us to trade at points of rejection and carry price back toward acceptance. So that's what we're doing. We're trading from rejection to acceptance. And as you look here, once we get outside of value, by any measure there, all of these price points are then carried back to value. Now it's not always perfect, but eventually price either goes back to value or it moves on and seeks new value, as we know. So this is the normal distribution. It's the curve right here that organizes all the prices for us. And we talked about the 68%, that's the value area. Well, 68% of the shares that traded, the volume that traded in a given price range, that's the value area. So that entire zone right there, that's where 68%. So that's where the average buyer and seller bought or sold at VPOC. That is value. The highest volume point is value, right? Everything around it, that is all considered the value area. And price points beyond that, where there's low volume, that's rejection points. All right, volume profiling basics. This is the normal distribution and how it reveals value now. And this is what's really important is that the normal distribution organizes all of the data in a very, very nice symmetrical bell-shaped curve. So you have the peak, and this is value, and then you have a symmetrical pattern that goes above or below value. But it's all around the single peak. But what's interesting about it is that it perfectly reveals exactly what we need to know to execute our core philosophy of auction market theory, because it tells us which price is value. And as you recall, first and foremost, as a trader, your number one goal is to always identify value in the chart. Where is value? Where is value now? Where is value in the short term, in the medium term, in the longer term time frame? Has value been trending higher? Has it been trending lower lately? Has it been back and forth in a range? That's what you need to ask yourself every single time when you strap in, where is value? And the peak of the curve tells us value right here, right? That's value. And if we're looking at the actual volume profile, it's this point here. But you can see value shifts throughout the day as trading information hits the market every nanosecond. Now, the other thing to keep in mind is not only does it reveal value, but it helps us identify when price is away from value or within a general value zone. So while this is the peak and is value, the space up to this point and the space down to this point, the value area, that encompasses acceptance, and that is 68% of the volume traded on any given period of time. 95% of all prices fall within 2 standard deviations of price. So here's value. The top of value, that's 1 standard deviation. And down to the bottom of value, that's 1 standard deviation. And once you get above that zone, now you're out to 2 standard deviations away from price and 2 standard deviations away from price. And once you get out to the very edge, now you are 3 standard deviations, 3 standard deviations. So 95% of prices fall between 2 standard deviations there from value. 68% of all prices fall within 1 standard deviation, and 99.7% of all prices fall within 3 standard deviations. But remember, the normal distribution is a continuous probability curve. So it always continues to go off in the distance this way and in the distance this way. And as you continue to throw data at it, that data will, for the most part, lie within the confines of that data set. So that's what's great about it as well, because as we use this profile for our trading benefits, we always know that it's going to organize the data in the exact same way that we should be looking for. If we're responsive buyers, we should be looking to buy below value and return it to value and perhaps to the top of value. And that's all we need to know about trading. Buy discounts and sell premiums. Sell premiums. That's all you need to know. Now let's talk about the normal distribution stats. The normal distribution stats clearly organize, again, in the various areas of the profile, of the distribution. Obviously, number 1 right here, this is the peak, that is value. That is where the most volume traded at that price level. Of any price level on the chart, that is the most traded price. And remember, all it takes is price and volume, and that is what makes value. The most volume traded, that is your value. The least amount of volume traded, those are your outliers. So right now, number 1, that is value. Number 2, 68% of all prices, again, fall within the value area. That's the bulk of the profile. That's the population density. That's also acceptance. 16% of prices are considered above value, and 16% of prices are considered below value. This is where you have the best opportunity to trade, is outside of value. That's a price anomaly, a discrepancy, an outlier, and your goal is to trade these outliers and return them back to value. That is always your goal as a responsive participant in the auction, is to identify value and return price to value when price has stepped outside the bounds of value. That's all you're looking to do. Because in a balanced profile is a perfectly evenly distributed distribution curve there. That's a perfectly balanced profile, looks like that. Okay? Like a D. In those days, the goal of the market is to facilitate trade. Remember, fair facilitation of trade is the #1 goal of the market. And this is the epitome of fair facilitation of trade. Buyers want it here, sellers want it here. So if you're a buyer, you come up here, you sell it here. If you're a seller, you sell it here, you take it down. And the process goes back and forth throughout the day. That's why this works. Now, our goal is also to identify these outliers at the very extremes. These are in your larger LVN nodes, your low volume nodes. These are also in multiple time frame low volume nodes. So not just for a specific day, but it could be for a rolling set of days. It could be a micro composite area. It could be a composite area. It could be a single day LVN. But these are your outliers. These are where the biggest rejection points occur. This is where the cleanest reversals occur. But if price pushes through those zones, it's also where the biggest and fastest breaks occur as well. Because then all the stops are let out above that zone. So LVNs are perhaps the strongest areas to watch on the charts at all times, because those are the points where price is rejected. There's low volume in those areas for a reason, because if all the volume is in acceptance and that's where everyone's trading, when price gets outside, that's when no volume occurs. And if no volume's occurring at those levels, it's because it's being rejected. The market doesn't want to trade here. That's why there's only 17 contracts that traded on the very top of this high. And at the very bottom, there was 27 contracts that traded on the very low, somewhere back here. But it's all based on the normal distribution, and that's how we're able to statistically trade with the best edge. If we know that 16% of prices below value, those are typically anomalies that lead price back to value, well then when you're looking to buy, you should only be looking to buy if it's below value, because that's the best edge to return price to value. That's the best edge. Likewise, if you're looking to sell, you need to be selling above value, because statistically, this 16% is a better area to sell it, to return it back to value where everyone wants it, because that's where everyone's traded it. So if we look at the normal distribution areas of the volume profile now, you'll notice that, again, #1 is the peak of the profile, and that is the volume point of control. Volume point of control. And this volume point of control is value. You can also just call it the point of control. But it is the level that signifies value, because, simply put, it is the level that has generated the most volume at that price. And that's all that matters with regards to value. So this is considered value, which is also synonymous with fair pricing. And if it's fair priced, then it's an acceptance area. That's the peak of the curve. That's number one. Number two, the value area. That's where 68% of the volume traded. Generally speaking, you want to trade at the edges of value, not within value. You want to trade at the extremes. So there's that black line there, there's that black line there. That is the value area. You want to trade at the edges and bring it back. That's what you want to do. Trade at the edges and bring price back every single time. That's the goal. Because if you trade in the middle, there is simply no edge. There's no edge to trade in the middle. Because typically speaking, that's where everybody has traded. And if everyone is doing something, there is no edge there. Now we're going to learn some specific approaches to when to trade at this level so that you catch this move. And it's looking for absorption at those levels. It's looking for trapped aggressive buyers at those levels. It's looking for price to go offered through those levels. And we're going to talk about all of that on when to trade that to expect to move down to the bottom of value. But for now, before we get ahead to the advanced techniques, you have to understand that if you're buying, it needs to be down here. You cannot buy up here. Not unless you really understand what's going on in the auction at that point. Because on a day where there's balanced trade, it's nothing but rejection to rejection. So it goes from rejection to acceptance and then back to rejection. And then rejection to acceptance, then back to rejection. That's the natural rhythm of the market. Now, once price gets above this line, that's the value area high, everything's considered a premium. Prices are at a premium. You sell premiums. You don't buy them. And when price gets below this line, this is the value area low, VAL, prices are at a discount. You buy discounts. This is like the sale rack at any store. When prices go on sale, everyone flocks to the sale rack because it's the same stuff, only now it's cheaper. And this is price, only now it's cheaper. And you buy discounts and return it back to value because everybody wants it at value. And lastly, the outliers. This is what we're looking for in price at all times. We're looking for those outliers. We're looking to see where they are, because if you can identify a true rejection point in the market, you can be filled on the highest tick or on the lowest tick if you have a ready to go resting limit order at those levels. If you have a resting bid or a resting offer at a true rejection zone, because of what the profile is telling you, you can get the high or low tick. You can. And it's all because you're identifying where no one wants it. That's why there was only 17 contracts that traded on the high point up there. It was unfair price. And price was rejected by the market, and it came back to value. Now that we've tied together the concepts of the distribution, of the normal distribution and how it ties volume profiling to our auction market theory, let's talk about the profile now. Let's talk about the profile. It basically allows us to execute our core methodology of auction market theory. And again, auction market theory guides us to identify areas of acceptance and rejection. And as we know, the distribution helps us identify those rejection points because that's where less volume occurred. Very simple. It's a very simple concept. Just think of it in some analogy that you know in everyday sense. Say, for example, there's a market for cookies in your neighborhood, and all of a sudden, those cookies are selling for, say, $5 a dozen. And that's value, and that's where everyone wants those cookies at $5. Well, once the demand goes up, you could price them higher, and maybe now up here they're $7. But once they were $7, nobody wanted to buy anymore, right? No one wanted to buy. At that point, the demand is gone, the supply is more, and that's when price has gone to a rejection point, and price will come back to $5 where you know there's value and you can sell more. And now, for the folks that were mad that you were selling them for 7, maybe they don't come back when price is at 5. So they let the market rotate lower to the bottom of value, and maybe down here you say, hey, we have a special $3 for a dozen right now only. And that's when you come back when price hits the bottom of value. And then once they hook you back in, they bring it back to value at $5 for that dozen of cookies. So that's what's going on. Auction market theory says find those price levels that have acceptance and rejection. Find them. And our goal as traders is to trade the unfair price extremes and then return price back to value and then perhaps all the way to the top of value. That's our goal every single time. When price gets above value and all the bids become absorbed up here by larger passive sellers, price is going to return back to value. That's what the market is supposed to do. So what's great about the profile is that it helps you see the auction process live and in its truest form through price and volume. If you want to feel like you are seeing the market, all you need is this information here. And that's why some of the truest volume profiling pros don't even need this price action. All they need to see the auction is this profile with these volume distributions here, so they can understand where value is, where the top of value is, where the bottom of value is, where those upper rejection points are, and where the lower rejection points are. That's all you need to know. It's not always this perfect of a profile, and we're going to learn the different types of profiles and how the profile will develop throughout the day, because as you look at this, you can see these dotted lines. That's the upper value area. So that's the value area high. And you can see how it changes constantly throughout the day. It changes constantly. And eventually, it stops and becomes this one line right here. At the end, or at the current, or at the present, that's where that value line is. But throughout the day, it was here, it was up here, and it was back down. Likewise, here's value. That's VPOC. Well, it also changes throughout. Here, 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 here. Because different volumes are being traded at different levels throughout the day, and when price auctions in an area long enough, it eventually shifts value back to that area. And here's the the value area low right here. That's the value area low, and this is the bottom of value, and you can see how it continuously updates as well. And eventually this is the final value area low, or that's the current or present location of the value area low. When you have a big volume peak like this, that is a high volume node. A high volume node, and that is indicative of acceptance. That is acceptance. When you have no volume on an edge, or you have some type of low volume valley, that is a low volume node, and that is rejection. That is price rejection. Remember, auction market theory guides us to identify areas of acceptance and rejection. And our goal is to fade unfair price extremes, which is rejection. And where's rejection? At a low volume node. At a low volume node. And then our goal is to return price back to value. Return price back to value. Because that's where everyone wants it. These are all little people right here, and there's a lot of them. There's not many people here. These are wholesale prices, and these are retail prices. This is the shop owner that owns a convenience store and buys gum for however much at wholesale, and then he sells it for retail because that's where everybody wants to buy it at retail. They don't want to fuss and get it for wholesale and do that thing. So this is the auction process, and you can see we have the auction process down here at the bottom right. This is the auction process: balance, excess, imbalance, value. Volume profiling helps us execute that auction process right there. So let's talk about the volume point of control now, VPOC, or just simply point of control, POC. VPOC is value. It is where the highest number of shares or contracts traded for any given period of time that the profile is being created for. You can see right here, 6,422 contracts traded at that level. That was the highest. But at the extreme, where we have the low volume nodes, there's 17 contracts right there. And on the very bottom down here, there is 27 contracts there. So this is value. Since it has the highest number of contracts or shares traded at that level, that means that the most buyers and sellers liked price at that level, and that's where fair facilitation of trade occurred, because that's where everyone wanted it. So that is value. So as traders, our number one goal, identify value in the charts. So your first goal is to look to see where value is. Value is this line right here. And then your next goal is to identify where value has been to help you forecast where it may be headed, higher or lower. But number one, identify value. That's the volume point of control. It's the price that has generated the most volume and is considered fair value among buyers and sellers. And once you find value, the zone around value is acceptance. So now this entire zone offers fair facilitation of trade between buyers and sellers. If you look at the profile here, and you can see how it's that bell-shaped curve again. Here's the line on top. Here's the line on bottom. Look how much trading occurred at these price levels. Here, 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 and all of this. And look how little action traded on the edges above it or below it. How little. That's exactly what you see in the profile. Here's the little bit that traded above. Here's a little bit that traded below. And this bulk is all the people that liked it in this price. So your goal as a fearless trader is that when price steps out of value, you buy that, because chances are it returns to value. If price steps outside of value, you sell that, because chances are it's going to return back to value. So that's the volume point of control. It's very, very important. It is a level that helps you identify value in any time frame, because remember, volume profiling can be used in any time frame on any type of chart, because the volume profile is created independent of time. Time does not matter when it comes to volume profiling. It's how much volume traded at this price level. You could be looking at a 1-day profile. You could be looking at a 2-bar profile. You could be looking at a 6-day profile or a 2-month profile. How much volume traded at that price, that's all you need to know. It doesn't matter about time. And that's what makes this approach so powerful. And every single thing that trades on the market has price and volume, right? Whether you're talking about stocks, ETFs, futures contracts, it has price and volume. So you can use this if you're a futures trader, or if you're a stock trader, or if you trade ETFs. If it has price and volume, you can create this right here, and you will always know where value is and where the value high and the value low is. You will always know unfair price extremes. And that's all you need to know to trade. The rest is mindset, the rest is discipline. Volume profiling also has a value area where all the business is conducted. We talked about VAH being the top of value, VAL being the bottom of value, and remember, value is defined by the volume point of control, the level with the most volume traded. The value area is the 68% of volume that traded around the volume point of control. So you get 68% of volume up here to here, evenly split in a perfect world, right? Which means you have 34% above and 34% below the volume point of control. And this is where 68% of the market traded. That's fair pricing. Fair pricing. This is acceptance between buyers and sellers. This is where agreeable pricing has been found for the market, and this is where the market likes to trade. So this offers fair facilitation of trade between buyers and sellers. The developing value high updates throughout the day, as does the developing value low, updates throughout the day. So it is your goal, as you see the auction update live, to understand what price is doing. For example, if you're looking at the developing value low here, and it shifts from here, higher, then higher, then higher, and then higher still, and price drops into it after this has been shifting higher, the pros easily see this. The computers are programmed to buy that already for a move higher, back to value. And then it worked this time. So when it comes back, what do you think is going to happen again? It's going to work again, back to value and back to the top of value. Now keep in mind, when you entered this trade long, say here, top of value was here, right there. But by the time price had got to value, the top of value, it had shifted lower. That's okay. The auction is a live, breathing thing that just continues to go and never sleeps, except for a little bit on Saturday. That's it. Otherwise, this thing is firing away 6 days a week. What happens when price drops back down to the bottom of value? Well, it goes back to value and then again to the top of value. And once it goes way outside the bounds here, it is rejected and price goes back down and back down again. So the developing value high, developing value low, the value low, those are key terms to understand as a volume profiler. These are key terms, as is the volume point of control. So we have unfair prices out here and fair prices all within the profile. 68% of prices fall within the value area. So now let's talk about the roles of the auction participants using volume profiling, using the auction process. And the first one we're going to talk about is the responsive participants. Because again, the goal here, as we execute our auction market theory blueprint, is to trade at rejection and return price back to acceptance. And as you recall, the outer edge of the profile has the lowest distribution of volume and thus is rejected by markets, by the market participants. So this entire area right here is basically rejection. So when price enters that space, price, our goal as responsive sellers or responsive selling participants in the auction is to sell it and take it back to value. 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 That's your goal every time it gets either to the top of value or beyond it. Likewise, if you're a responsive buyer, you take it at the bottom of value and return it to value. Bottom of value, return it to value. Bottom of value, return it to value. Now, one thing to keep in mind, price doesn't always adhere to the bottom. Sometimes they run the stops and price drops, but there's always further rejection. So if it doesn't work the first time, it's likely going to work on another leg because these reversals aren't always clean. Just looking at this chart, you have a clean reversal here. You have kind of a double dipping reversal here, and then you have a very choppy reversal with a stops run attached. So this is exactly what you need to look for every single time is how's price responding. Right now it's quick rejections, but sometimes it may be quite a while before price actually gets going in that direction. Other times it may be a gradual but very sharp reversal, and other times it's a grind big time. And even once price goes bid, they still run the stops all the way back to the breakout point before they take it back to value a second time. So this is a very important concept, but it's a very simple concept to understand. Acceptance is in the middle, and this entire value area, that's acceptance. And when price goes to rejection, it's like you're a tennis player. A tennis ball is coming from acceptance to you at rejection, and you smack it with your tennis racket back to acceptance and then back to the other side of value. And when price comes up to you again, you smack it with your racket and you drop it back to the other side. That's being a responsive participant in the auction process. So now let's talk about initiative participants. The auction market theory not only guides us to trade at rejection levels and return price to acceptance as responsive participants, but it also guides us that should price push through a rejection point or a price that has been rejected by the market is then likely out of balance and has transitioned to a price discovery phase seeking new or prior value. So this is the point where we stop being responsive participants and we then shift gears to an initiative role. And you can see down here, number one, initiative sellers enter the market in the bottom 50% of the price distribution, and they look to return price to either prior value or look to create new value. So if they're entering in the bottom 50% of the price distribution as an initiative seller, that means that if the price distribution profile is a perfect mirror image and the peak is volume, point of control, that's value, then 50% above it equals the 50% below it. So in essence, what you're saying here is that initiative sellers sell in the bottom 50% of the profile, find the volume point of control, and that is the 0 point, and below it is the bottom 50% of the profile, and above it is the top 50% of the profile. So basically, an initiative seller would sell anywhere from VPOC down below value because they are looking for price to aggressively seek new value or a prior value area. Because what's happening here? If the price is going to move and look for new value, then the prior area of acceptance has been rejected. That's what's happening. Where there was acceptance before, the market is now rejecting that acceptance, which means the market is going to look to create new acceptance. And that's what happens. Now, what happens if the market pushes in a direction and doesn't create enough volume in that area to create new acceptance? Well, then price returns to the prior new acceptance, and oftentimes auctions even higher toward the prior acceptance before that. That is basically the rhythm of the market, as we know. That is the auction process. Down here, you go from balance to excess to imbalance to value, and then you go back to balance. Okay? So here's balance. Here's the excess, the imbalance. Here's the search for new value, and then, of course, the creation of balance once that occurs. That is all that happened here. So as an initiative seller, you're selling in the bottom 50%, typically at VPOC or below the value low, and you look for price to push in that direction toward either a prior area of value, or you look for price to sludge around and create new value by a VPOC shift lower. If you're an initiative buyer, then you'd be buying from VPOC through the value high. So you'd be looking to buy here. So these were initiative buyers, and they weren't able to get price higher, and instead they were faded back to value and back to the value low by responsive participants. So these are initiative participants, and you have to identify what's going on, who's trying to lead, so that you can identify if they're winning the ball game or losing. Because if you know initiative participants are selling here and you're not in the market yet, well, then you need to say, okay, what do they need in order to take this thing lower? Well, they need to take out the stops below here. And once they take out the stops below there, price never came back to retest. Instead, it continued lower. But what happens? Maybe you missed this and you're like, wow, are they going to find value here, or are we going to reject now? What's going to happen? Well, if you got short in here and price comes down here and all of a sudden you have a high and a high, what are you doing if you're short? You're moving your stop from, here or here or here or wherever, depending upon where you got in. You're moving your stop right to here, right? So this is what you need to know. If initiative sellers are short and you are looking to enter the market, are you going to follow the initiative sellers, or if you're going to see if the weak hands are shaken out? Because if the weak hands are shaken out here, then these initiative sellers, all of these guys that got short, all of these initiative sellers that got short are going to start getting their stops popped, and it's going to go right back to the breakout point and right back to value, because they weren't able to generate enough volume down here to gain acceptance. And instead, that was rejected, and OTF, market responsive participants, entered the market at that point and returned price to value, and then auctioned it higher toward prior value as well. So again, trading is all about understanding auction market theory, understanding the goals of the various types of market participants, and then understanding value, understanding acceptance and balance, understanding when price is out of balance and out of value, so that you can either return price to value or you can take price to new value. That's all that trading is. You have to understand this, not by, hey, this bar is green and it's going up, and this bar is red and it's going down, and I have little blinky things telling me to buy and sell here. No. What you need to do is understand the auction, understand why and whom is buying here, because if they are looking for price to go much higher and their stops are run, this happens. And you can forecast this if you know whose stops are being taken out, either on the bottom or on the top. So that's what trading's all about. It's understanding the auction process, understanding the market participants, and then understanding value and when price gets outside of value. If you understand value and fair pricing and unfair pricing, and if you understand acceptance and rejection, and you understand the two roles of market participants as buyers and as sellers, initiative and responsive, that's all you need to know to become a successful trader using volume profiling and auction market theory. The rest is just technique and discipline and mindset, and that's what we're going to be learning the rest of this master's course. So that does it for this portion here of volume profiling basics under the core analysis module. for Pivot Boss Masters.